Thank you, Kevin. Last time I gave a speech at Marine Money in New York, I had to walk onto the stage to the sound of ABBA. So I was somewhat relieved that the new owners of Marine Money did not insist on that for the London event. And by the way, congratulations to Marine Money and also to Diversified on the sale and purchase. I think already a very strong contender for Deal of the Year, so well done on that. Speaking of deals, I'm going to be talking about how we might use vessel valuation data to inform investment decisions. And I will structure the talk as follows. I will say a little bit about vessels value. Then I will talk about fixed age valuations, how we generate those data. Next, I'll say how we can turn those data into buy and sell signals. I'll talk a little bit about inflation. Then discounted cash flows, and in particular, I want to talk there about the price earnings gap that we heard about earlier in the day. And then finally, I'll talk about how we can use other data sets and other information to add context to our analyses. So firstly, a little bit about vessels value. I think everybody in the room, or almost everybody in the room, will be familiar with what we do. Essentially, we're an online valuation and data platform. We value around 70,000 vessels every day, track around $2 trillion worth of tonnage. We have 130,000 vessel transactions in our database, and we cover 8 different levels of vessel ownership. Let's talk about how we generate our valuation data, because that's the key input to the buy and sell signals that I'm going to be describing. So we have an automated vessel valuation model, which I helped to write some 15 years ago, and has been in continuous development since then. And what it is it's a statistical model which values vessels in a vessel-specific way. In other words, it takes into account all of their different characteristics. It's calibrated daily to market data. It's supported by measurable accuracy metrics, and it is independent, it is objective, and it is confidential. We do not see what you are looking at on our platform. The input data are vessel particulars, sale and purchase transactions, freight earnings data, and also steel prices. And these are gathered and curated by specialists across Veson Nautical. And the little graphic at the bottom of this slide says that if you have garbage data going into a model of any level of sophistication, you're going to get garbage data coming out of it. So we make sure we do not do that. This is what the output data from our model look like. And what I'm showing on the screen here is a valuation time series of a VLCC that was built in 2001. So it's a vessel that will be that is approaching its retirement age this year. And what I want to do for the purposes of this analysis is I want to remove the depreciation component from our model so that we now have a time series of a VLCC that was always 0 years old throughout the history. That's the blue line here. And this is what we call fixed age market value. And this is going to be the key input to the analysis we're going to do next. So what we're going to do is I should say, what's significant about this signal? Well, it's a pure market indicator. By removing depreciation, what it means is that value changes are driven purely by market changes. They're not driven by the aging of the vessel. And it helps to answer the question, where are we in the cycle? And our clients use these sorts of data sets to inform their investment and divestment decisions in tonnage. Some of the methods they use they will compute statistics from the historical value distributions. That's highlighted in orange because that's what I'm going to talk about today. Some of our more sophisticated clients will fit trend models to these data and project forwards, or they will fit stochastic process models and simulate future scenarios, which allows people to get a gauge of possible risks involved with investments. I'm just going to do the first, which is the simplest of the 3 options. and this is going to help us construct some buy-sell signals. So I've got the same plot here, which is the 0-year-old VLCC vessel, and I've put on here some very basic statistics. I've got the minimum, the maximum, the median, which is the black dashed line, and then the current value, which is marked in red. And you can see from this chart that the current value is considerably higher than the median value. In fact, there's not much time in history where the value has been higher than today's value. And so the obvious thing to do here is to take that time series and collapse it into a histogram, showing how long the value has stayed at each of the different levels. And if we do that, we see that the current value is $141 million. It's only been higher than that 4% of the time in history, and it has therefore been lower than that 96% of the time in history. And so that, if you like, is your short VLCC case that we heard about earlier today from Simon. I would caveat that this is a analysis that's purely based on historical data, so it's context and narrative free, but it is, I believe, a good baseline on which to build a buy or sell case. And so what I've done here is I've done the same analysis, but for lots of different sectors and lots of different ages. Where the percentage is high, as it was for the 0-year-old VLCC, I've got a sell case, or potential sell case, which is marked in red. And where the percentage is low, I've got a potential buy case, which I mark in green. And so I call this the heat map. And as you can see, on the left, my torso is obscuring it, but on the left we have a January 2026. So that table on the left is for now. And what we're seeing right now is that almost everything is a sell, a possible exception for the older gas tonnage. If we dial back 5 years and look at what the heat map looked like in January 2021, we see a more mixed picture with a lot of sell signals in the market. So if you've just done something as simple as this, which really just involves using the percentile function in Excel and buying some VV data, of course, you would have bought a load of tonnage in 2021 and you'd be in a good position to sell it now. So that's the basic analysis. Let's now talk about inflation. So all of the valuations that we produce and that I've shown you so far are in nominal US dollars, which then raises the question, should we be adjusting these valuations, given that some of them go back 25 years, for inflation? And I think there are two schools of thought here. Some people think no, primarily because vessel price inflation is typically a lot slower than the more normally reported consumption-based metrics. You can see that just by looking at long time series of vessel valuations. I tend to fall into the camp that says we should be adjusting for inflation because we are analysing multi-decade time series or trying to do so on a ceteris paribus basis. So we should adjust our dollars, and also, more importantly, real returns matter to investors. So I'm going to do the inflation adjustment. The blue line is the nominal dollar line that we saw before for the 0-year-old VLCC, and I have used the US producer price index to adjust for inflation over the last 25 years, which obviously will lift up the older values and produces the orange line here. And I'm going to do the same analysis with this orange line, which is inflation adjusted. And we see a very different picture. So if we look now at where the current value sits relative to the historical distribution, it is a lot closer to the median. So if you adjust for inflation, you do not get these sort of obvious short VLCC signals that you might have got if you hadn't adjusted. And that's reflected in the more nuanced heat map that you see, after you've done the inflation adjustment. So here we get a much more mixed picture, I think a more interesting picture, where you can potentially pick out sectors that are investable and sectors that are divestable, and this will form the basis for a more comprehensive and nuanced analysis. So that's what I wanted to say about inflation. I think the slides will be available to the audience afterwards. So if you can't quite see these numbers, or if you want to study them in more detail, they'll be available to you. Let's now talk about earnings, because I've said a lot about asset prices, but what about income and expenditure? Well, that's not a problem, because Vesel's Value also has a discounted cash flow module. I think everybody here will be familiar with DCF. Essentially, you project forward all of the incomings and outgoings associated with the running of a vessel for its remaining life, and then you form the net present value of those future cash flows. And that will give you a very different sort of valuation. Instead of being a market value, which tries to estimate what will happen in a transaction between a willing buyer and a willing seller in today's market, you get a valuation that is based on the future earnings prospects of the vessel. And you can compare the two. So if the market value is higher than the discounted cash flow value, then you could argue that the vessel is overvalued relative to its income prospects and would therefore be a sell. And you would say the converse if the market value was considerably less than the discounted cash flow value. So what I've proposed as a buy-sell indicator, or you could equally think of it as a measure of the price-earnings gap, is the logarithm of the ratio of the market value to the discounted cash flow value. So when the market value is higher than the DCF value, this number will be positive, and when it's lower, this number will be negative, and a positive number will indicate a potential sell, negative number will therefore indicate a potential buy. And the nice thing about this kind of analysis is that you can put your own future cash flow assumptions into the model to impose your view of the market onto these valuations. Of course, that comes with the warning. This analysis is extremely sensitive to the assumptions that you put into the model, so you need to be careful that those are robust and reliable. And so what sort of heat map do I get if I look at discounted cash flow valuations? Well, here it is. On the left, we've got today's heat map, and we see that we have a rather different picture from what we got just by looking at historical distributions of asset prices. We now see a mixed picture. In particular, it looks from this picture that the bulker sectors are overvalued relative to their earnings potential, and there are sell opportunities there. And in the tanker container sectors, particularly for the older tonnage, these look more like buys. And again, if we go back to January 2021, we can see what the analysis was 5 years ago. And now I think the most interesting thing we can do is compare what this income-based analysis says with what the analysis of the historical valuation distribution says. So on the left, I've got my income-based heat map, the price-earnings gap heat map, and on the right, I've got the inflation-adjusted distributional heat map. And they're a little bit different. But, and this is where I think it gets really interesting, there are a few areas where the two analyses agree. And so if you look at the Cape sector and the large LNG and medium LPG sectors, we get rows of this matrix that are pretty similar. And I think if you have two completely different and independent methods giving you the same message, this is where you should be looking. This is where the potentially strong signals lie. So if I had to make any recommendations in my talk, which I'm not in the habit of doing, I'd be looking at these three sectors right now. And finally, just to wrap up, as I mentioned before, everything I presented here is purely data-driven. It provides a context-free base case for decisions that you might want to make. But prices can be low or high for very sound and persistent reasons. And we've talked a lot about geopolitics today. We've talked about decarbonisation. There is context here that is not going away, and that can, if you like, trump the data, or at least need to be layered on top of the data. So I like to think of a data-driven buy or sell signal as the start of a conversation, not the end of it. And I would recommend layering additional information to paint a fuller picture. And at Veson Nautical, we have forecast market values where you can add some macroeconomic outlook. We have market values with charter, which can account for specific employment, and we have a host of environmental data as well. And I would not want to discount the role of the analyst either. I think expert analysis can turn data into narrative. I'm pleased to be joined here by 3 of our top analysts, and do speak to them in the networking sessions if you're interested. They've recently released a report product called Maritime Market Watch, which contains a lot of high-quality data. If you're interested in that, there's a QR code there in the slides, and you can also speak to them. And with that, I will thank you very much and enjoy the rest of the conference. Thank you.